Welcome to Investment IQ Insights. Here, we empower you to take control of your financial future. Discover invaluable personal finance tips and expert stock market investment strategies to make informed decisions and grow your wealth. In this video, we will be looking at the traits that all great stocks possess according to Warren Buffett, the world's greatest and most successful investor. Let's dive in. Don't forget to subscribe to our channel and ring the notification bell so you won't miss out on any new videos when we release them in the future. Trait number 1. Warren Buffett emphasizes the importance of strong and consistent earnings growth. He believes that this is a fundamental aspect of a successful business strategy. This means a company's ability to increase its profits year after year, regardless of economic conditions. It reflects the company's resilience and adaptability in a competitive market. Companies that can consistently grow their earnings are often well managed and operate in industries with significant growth potential. These companies usually have strong leadership, innovative products, and efficient operations. Earnings growth is a key indicator that a company is doing something right. It suggests that the company is not only increasing its revenue but also managing its expenses effectively. It shows that the business can generate more revenue and manage its costs effectively. This balance is crucial for long-term sustainability and profitability. If a company can grow its earnings consistently, it's a good sign that it has a competitive edge in its industry. This competitive edge could be due to superior technology, better customer service, or a unique product offering. Investors are willing to pay a premium for companies that show consistent growth, leading to capital appreciation. This is because such companies are perceived as lower risk and more likely to provide steady returns. This is why it's one of the first things Warren Buffett looks for when evaluating a stock. He understands that strong earnings growth is a reliable indicator of a company's overall health and future potential. In addition to financial metrics, Buffett also considers the company's market position, competitive advantages, and management quality. All these factors contribute to sustainable earnings growth. By focusing on companies with strong earnings growth, investors can build a robust and resilient portfolio that stands the test of time. This approach aligns with Buffett's long-term investment philosophy. Trait number 2. One of the most critical factors Warren Buffett considers when evaluating a company is its competitive advantage, often referred to as the moat. This concept is central to his investment philosophy and has been a key driver of his success over the decades. A competitive advantage is what sets a company apart from its competitors and allows it to maintain profitability over the long term. It is the unique edge that enables a business to outperform others in its industry. Think of it as a protective barrier that keeps competitors at bay, much like a moat around a castle. This barrier can take many forms and is crucial for a company's sustained success. Competitive advantages can come in various forms, such as a strong brand name, cost leadership, or innovation. Each of these elements can provide a significant edge in the marketplace. For example, a strong brand name like Coca-Cola leads to consistent sales and profits. The brand's global recognition and customer loyalty make it difficult for competitors to take market share. Companies that can produce goods or services at a lower cost can offer lower prices or achieve higher margins. This cost leadership allows them to attract price-sensitive customers and maintain a competitive edge. Innovation is another critical factor that keeps companies ahead of the competition, especially in the technology sector. Companies that continually innovate can offer new and improved products, keeping customers engaged and competitors at a distance. High switching costs make it less likely for customers to leave, as seen in software companies. When customers invest time and resources into learning a particular software, they are less inclined to switch to a competitor. Network effects occur when a product becomes more valuable as more people use it, like social media platforms. The more users a platform has, the more attractive it becomes to new users, creating a self-reinforcing cycle of growth. Regulatory advantages in heavily regulated industries also serve as a moat. Companies that navigate complex regulations effectively can maintain a strong position in the market, as new entrants may find it challenging to comply with these regulations. In summary, a strong competitive advantage is essential for long-term success and profitability. It provides the foundation for a company to thrive in a competitive landscape, ensuring sustained growth and resilience against market fluctuations. Understanding and identifying these competitive advantages can help investors make informed decisions. By focusing on companies with robust moats, investors can increase their chances of achieving favorable returns over time. Warren Buffett's emphasis on competitive advantage highlights the importance of looking beyond short-term gains. Instead, he focuses on the long-term potential and sustainability of a company's business model. Ultimately, a well-established competitive advantage not only secures a company's market position, but also drives innovation and growth. It is the cornerstone of enduring success in the business world. Trait number 3. Warren Buffett looks for a strong management team and great stocks. The people running the company play a pivotal role in its success or failure. A competent and trustworthy management team can make strategic decisions that drive growth. Evaluate the quality of the management team by looking at their track record. Buffett values transparency and honesty in a management team. Great leaders understand the importance of reinvesting profits back into the business. It's also important to evaluate the management team's vision for the future. In summary, a strong management team is a critical component of a great stock. Trait number 4. Warren Buffett prefers companies with low debt levels. Low debt levels indicate financial stability and reduce the risk of bankruptcy. Companies with minimal debt have more flexibility to navigate economic downturns. High debt levels can strain a company's cash flow and lead to difficulties in meeting debt obligations. Low debt levels allow companies to take advantage of growth opportunities. Companies with low debt are less exposed to financial risk. Buffett also considers the cost of debt when evaluating a company's financial health. Low debt levels can lead to higher returns for shareholders. In summary, low debt levels are a crucial trait of great stocks, according to Warren Buffett. Trait number 5. The final trait Warren Buffett looks for in a potential investment is an attractive valuation. This means identifying stocks that are trading for less than their intrinsic value, providing a potential for significant returns. One of the primary methods to evaluate a stock's valuation is by examining its price-to-earnings, or PE ratio. A low PE ratio can be a strong indicator that a stock is undervalued, suggesting it might be a good buy. In addition to the PE ratio, Buffett also pays close attention to the company's price-to-book, or PB ratio. A low PB ratio can imply that the stock is trading below the value of its assets, making it an attractive investment opportunity. Another crucial metric in Buffett's valuation toolkit is the discounted cash flow, or DCF analysis. This method estimates the value of an investment based on its expected future cash flows. Buffett emphasizes the importance of a margin of safety, which means buying stocks at a significant discount to their intrinsic value to minimize risk and maximize potential returns. His approach to valuation is inherently long-term, focusing on stocks that not only appear undervalued now, but also have the potential to appreciate significantly over time. In summary, an attractive valuation is a cornerstone of Warren Buffett's investment strategy. By seeking out stocks that are undervalued using metrics like the PE ratio, PB ratio, and DCF analysis, and ensuring a margin of safety, Buffett aims to build a portfolio that will grow steadily and robustly over the long term. Thank you for joining us on this journey through Warren Buffett's investment principles. By focusing on strong earnings growth, competitive advantage, a strong management team, low debt levels, and attractive valuation, you can identify great stocks. Remember, these traits are the foundation of Buffett's incredible success. Please subscribe to our channel to stay updated with our latest videos and insights. If you like this video, check out the 2 videos now appearing on the screen. We bet that you will like them too. Thank you for watching, and we'll see you in the next video.